When I do these weekly updates, sometimes I recount conversations I have with a friend of mine who's the head of research here in Singapore for one of the Swiss private banks. And it just so happens a couple of days ago, he was recounting to me a presentation that he was giving where he was pointing out that the VIX index, the measure of implied volatility of the S&P 500, was at about 15%, and that's low. And his conclusion, or what he was telling his clients, is that volatility was kind of going to be low or going lower. And I said, really, I kind of told him that's not actually the right conclusion to make. It's not entirely wrong. But really the way to frame that comment is that over the last 20 days, actual volatility, observed volatility, sometimes even called historic volatility, had been around 7%, which is very, very low. So if implied volatility is 15, even though that's lower than long-term average implied volatility, it does mean that the market is expecting a pickup on volatility from the extremely low levels we've been having lately to something that's a little bit more normal going forward. Let me try to put in perspective how low 7 is. So basically what it's saying is that you're basically annualizing what the little ups and downs that we're having every day are, and you're trying to say, well, what does that mean in terms of what you would expect from an annual return? And so 7% basically means that there's probably a 2/3 chance that within the next 12 months, the market will not be up more than 7% or down more than 7%. And that's a wonderful way to look at how great the US equity market has been this year, because right now we're in July and the S&P 500 is up about 9%. It's up 1.3% over the last week. So you had a 9% return, even though the actual ups and downs of the market kind of indicate, for the last 20 days have indicated like 7%. And actually, if I kind of say it that way, people will say, well, wasn't the market a lot more volatile earlier in the year? And that's certainly true. We had a bout of volatility back in April when Trump introduced his Liberation Day tariffs. But even including that Liberation Day tariff bout of volatility, S&P 500 volatility has been just about average this year. So with average volatility in the market only in the month of July up around 9%, this has been a pretty easy year to invest. And the same thing is kind of true for the bond market. We did have above average volatility in the Treasury market at the beginning of the year. But in the Treasury market, just like, there's a similar index of measuring volatility. It's called the MOVE Index, which is a Merrill Lynch measure of Treasury market volatility. That has been moving down as well lately. And in fact, we're at levels now which are, to find lower levels for that index, you have to go back around 3 years. And at the same, just like the S&P has produced pretty solid returns this year, most bond funds that most of our clients would be investing in have produced pretty solid returns so far this year. I tend to use the Vanguard Intermediate ETF, a corporate bond ETF. The VCIT is sort of a proxy for bond investing, and that's up about 5.3% year to date. So, basically that's a pretty good return going into July from the bond market. So this is really, even though if you're watching the television, they're talking about all the craziness of Trump and all this stuff, this has really been a pretty excellent year for investors. You've had S&P is up about 9% through July with sort of average volatility and very low volatility right now. And you've had a very solid return from bond funds as well. And gold has put in a very good return, and Bitcoin as well. So if you're not making money right now, you got to question what you've been doing. Now, back to one of my original points here is that implied volatility is definitely higher than the very low volatility that we're experiencing or have been experiencing for the last 20 days. And it kind of makes sense that we're going to get some pickup because we have a whole raft of financial news coming out during the balance of this week. I'm speaking to you on Tuesday in Singapore. Later today in the US on Tuesday, we're going to have the JOLTS report, which is a Labor Department report on job turnover and leaving. And basically that report, the market doesn't pay a super amount of attention to, even though it contains a lot of great information, mainly because that report will be from June, so it's not so current. But the previous reports have basically told an interesting story. There are not many layoffs going on in the US market, so people are fairly secure in their job, but there's not a lot of people right now, at least relative to like last year, leaving their jobs, which is usually a sign that the job market's very buoyant and they're finding better opportunities elsewhere. So the expectation for that report is to get more of the same. Not a lot of layoffs, and people are sticking to their jobs because the job market isn't very buoyant. If we get that, of course, that's good for the bond market. That'll be good for the equity market because people want that story. They don't want a very buoyant job market because that means that inflation will remain sticky. And of course, they don't want to see a lot of layoffs because then some recession fears will start creeping into the market. Also going on today is a lot of different earnings reports. Now, earnings have been generally pretty positive so far. 80% of the companies that have reported in the S&P have beaten on earnings. If these earnings beats continue, we're probably going to have year-on-year earnings growth for the S&P 500 for the second quarter of like 8 to 9%. Now, that's not as good as the double-digit growth we had in the first quarter or the fourth quarter last year, but it's still very solid earnings growth, and that's part of the reason probably that the S&P 500 is currently at an all-time high. Looking at the different companies reporting, one of the things that analysts expect to hear is some comment that margins are being reduced by the tariffs. Up till now, we haven't had a lot of that. And of course, that's good news if you're an equity investor. And that's, once again, another reason why the S&P is at an all-time high. But we got a lot of reports coming out, and investors will be listening to the comments from CFOs and CEOs on whether tariffs are having any impact on their margins. The other thing that people will be looking at is signs of weakness in the US consumer. Now, companies that report about the US consumers have generally been reporting for the last couple of quarters that lower income consumers appear to be squeezed. So if you hear some negative things about US consumers, our lower income consumers being very price conscious, that shouldn't really affect the market. That should be no surprise. However, Visa is reporting after the close on Wednesday, after the close today on Tuesday, and Visa, as well as MasterCard and Amex, have been saying for the last several quarters that their biggest clients, who are obviously the higher spenders, are doing just fine. They're not seeing a lot of weakness in their consumer. So that's really something that has kind of kept the US economy going, higher income people continuing to spend. So people will be looking at what Visa says on their earnings report to see if that story continues. It would be a big negative if Visa started saying, no, we're starting to see our clients, our core higher income clients, acting a little bit more cautious about their spending. Now, after that, we go into Wednesday. We have 3 of the big Mag 7 stocks reporting. It's very unlikely any of their reports will be big surprises. But remember, we've had a very buoyant market. So unless they really knock it out of the park, and that the ones reporting are Meta, Microsoft and Amazon, unless they really rock it out of the park, I would expect the analysts or the market to find some fault in their earnings, however good they are. And you would probably see some profit taking come in, and maybe that would lead to a little bit of a pullback in the whole market. Basically, I'm not predicting any kind of big surprise, but I just think the way the market's been going, it's hard to imagine that all three of those companies are going to really be pleasing their investors. And maybe overshadowing their earnings on Wednesday will be the end of the Fed July meeting. Now, we kind of already know where the Fed's coming from. The Fed is basically saying we've kept interest rates fairly high, we've managed to avoid a recession, the job market remains stable, and we're seeing a little bit of pickup in inflation due to the tariffs. And Fed Chairman Jay Powell will be able to point to data saying that inflation has picked up a bit to the tariffs. But then he would probably repeat that the Fed's inclination is that any increase of inflation from tariffs will be temporary. And what the Fed is waiting for is sort of confirmation that it is temporary and inflation starts dropping again before they do cuts. And as long as that narrative remains in place, you would expect expectations for rate cuts, which already are expected at the Fed's next meeting after July, which occurs in September, to increase. And of course, what the market really wants, what the equity market really wants, is lots of Fed rate cuts. So it's not just Donald Trump who wants the Fed to cut more rates, it's the bulls on Wall Street as well. Now, whatever the Fed does, maybe that only affects the market for one day, because coming in on Thursday is a big piece of inflation data. That would be the June PCE data. Once again, the expectations are to show some signs of inflation picking up due to the tariffs. But as long as that pickup in inflation is in line with expectations, the basic market conclusion from that will be that the increase is going to be temporary. And once those tariffs are fully in place, inflation will begin declining again, and the Fed will be in position to cut rates. So that's what we expect from the PCE. And finishing off the week is the important non-farm payroll report for July. This one will be a little less important than other ones because the Fed only meets again in September, so we'll have an August report. But what the market, of course, wants to see is that the job market continues to moderate in the U.S., so therefore it's not inflationary. The job market is moderating. But however, we don't want such a poor jobs report that recession fears come back into the market, and that would be a reason for the equity market to sell off. So as long as the market gets what it wants on all those reports, you're going to continue to have low volatility in the market. You're going to continue to have the S&P 500, even though I said there's certainly some inclination there to take profit. You're going to continue to see it go up. However, with so much stuff going on, I'm sure some of the things that'll come out during the course of this week will be negative, and it'll just be a question of what kind of impact does it have in the market. For people who like volatility, for those traders on Wall Street, maybe they'll get a little bit lucky. They'll get a little more ups and downs in the market from the very placid market we've had for the last month. Thank you. Have a good week.